2026 was supposed to be the year the U.S. housing market finally came back. Buyers were supposed to return. Sellers were supposed to list. Mortgage rates were supposed to cool down, and the so-called Great Housing Reset was supposed to begin. But now look at what is actually happening. Existing home sales in April 2026 were running at only 4.02 million annualized units, up just 0.2% from March. That is not a comeback, that is a market barely breathing, and here is the part most people are missing. Americans are not just priced out by home prices. They are being financially drained before they even reach the front door. Childcare, gas, insurance, food, rent, interest rates, job insecurity, medical bills, student loans. And then, after all of that, the housing market still expects them to show up with a down payment. That is not a housing recovery, that is a financial trap. For months, analysts kept saying 2026 would be the year buyers came back. They said affordability would improve. They said more inventory would help. They said income growth would slowly catch up. They said buyers were just waiting on the sidelines. But the real world is not following that script, because people are not looking at a house and asking only one question. Can I afford the mortgage? They are asking something much darker. Can I survive everything else first? That is why this housing market is so frozen. The industry wants to blame mortgage rates because that is simple. But the truth is not simple anymore. The truth is that the average American household is now fighting a war on multiple fronts. And housing is just the biggest enemy at the end of the line, before someone even gets to the mortgage payment. They are already being hit by childcare, rent, groceries, insurance, gas, car payments, medical costs, and inflation. So when experts say buyers will come back when rates fall, they are missing the real problem. A slightly lower mortgage rate does not fix a household that is already bleeding money every single month. Let us start with the basic math. The median existing home price in April hit $417,700, which was a record high for April. Now assume a buyer puts 20% down. That means they still need to borrow roughly $334,160. With a 30-year fixed mortgage rate around the mid-6% range. The principal and interest alone can easily come out to more than $2,000 per month, and that is before everything else. Before property tax, before homeowner's insurance, before HOA fees, before repairs, before utilities. Before maintenance, before closing costs, before the emergency fund that every homeowner should have. But many do not. This is where the dream starts to break, because people are not just buying a house anymore. They are buying a monthly obligation that can destroy them if one thing goes wrong: one job loss, one medical bill, one car repair, one insurance increase, one property tax reassessment, and suddenly, the house that was supposed to represent stability becomes the thing that traps them. Let us start with the basic math. The median existing home price in April hit $417,700, which was a record high for April. Now assume a buyer puts 20% down. That means they still need to borrow roughly $334,160. With a 30-year fixed mortgage rate around the mid-6% range. The principal and interest alone can easily come out to more than $2,000 per month, and that is before everything else. Before property tax, before homeowner's insurance, before HOA fees, before repairs, before utilities. Before maintenance, before closing costs, before the emergency fund that every homeowner should have. But many do not. This is where the dream starts to break, because people are not just buying a house anymore. They are buying a monthly obligation that can destroy them if one thing goes wrong: one job loss, one medical bill, one car repair, one insurance increase, one property tax reassessment, and suddenly, the house that was supposed to represent stability becomes the thing that traps them. That is why so many buyers are hesitating. They are not stupid. They are not lazy. They are not waiting because they do not want a home. They are waiting because the numbers do not make sense. A $2,000 mortgage payment sounds bad enough. But once you add taxes, insurance, repairs, utilities, and inflation, that payment can easily feel like $3,000 or $4,000 a month in real life. And that is for a normal home, not a mansion, not a luxury property, not something in Beverly Hills. Just a regular house that used to be considered middle class. That is the real crisis. The middle class house is no longer priced for the middle class. Now let us talk about one cost that almost nobody connects to the housing market: childcare. And this is important because one of the biggest reasons people buy homes is to start a family, raise kids, and settle down. But in America right now, having kids can destroy the ability to buy the home you need for those kids. The U.S. Department of Health and Human Services defines child care as affordable when it costs 7% or less of a family's income. But Realtor.com reported that in every state, typical families now exceed that threshold, which means they are considered cost-burdened by child care, and the timing could not be worse, because at the same time, 1 in 3 homeowners and 1 in 2 renters are already considered cost-burdened by housing. So now 2 of the biggest expenses in a family's life are directly competing with each other. Do you pay for child care so you can work? Or do you save for a down payment? Do you pay the rent? Or do you keep your job by paying someone to watch your child? This is the kind of financial trap that does not show up in the basic housing headlines. A headline might say, "Mortgage rates are too high, but the real household conversation is more painful. We would love to buy a home. But daycare costs almost as much as a mortgage, and that is not an exaggeration. Child care has become so expensive that in many areas, it can compete directly with housing costs." According to Child Care Aware of America, families are now facing child care prices that rival major household expenses, and in many cases, the cost can be higher than rent or a mortgage payment. So imagine a young couple trying to buy a home. They are paying rent, they are paying car insurance, they are paying health insurance, they are paying groceries. They are paying gas, they may still have student loans, they may have a car loan, and then child care alone can cost over $1,000 per month. Sometimes much more. At that point, child care is not just an expense. It is a second mortgage before the first mortgage even begins. And the more you think about it, the more broken the system becomes. Because people are told, start a family. Buy a home, build the American dream. But the moment they actually start a family, the cost of raising that family makes it harder to buy the home. That is the contradiction. The system tells people to grow up, settle down, have kids, and buy property. Then it prices them out for doing exactly that. And this is not just theory. There are real families making life-changing decisions because of this. One American couple said they could not afford to raise a child in the United States, and that housing and child care costs were major reasons behind their decision to move abroad. According to a March 2026 report, they found that the cost of raising their child outside the U.S. was much lower compared with what they were facing back home. Think about how serious that is. This is not someone saying, "We cannot afford a luxury vacation." This is not someone saying, "We cannot afford a bigger car." This is a family saying, "We cannot afford to raise a child in our own country." That should be a warning sign. Because when housing and child care become so expensive that families start leaving the country or delaying children, the problem is no longer just personal finance, it becomes a national problem. It changes birth rates, it changes communities, it changes labor markets, it changes who can build wealth. It changes who can stay in the middle class, and it completely changes the housing market. Because the traditional homebuyer was often a couple starting a family, but if that couple cannot afford childcare, cannot afford rent, cannot afford medical bills, and cannot save for a down payment, then where is the next generation of buyers supposed to come from? That is the part many housing analysts still do not want to face. They keep talking like demand is temporarily delayed, but for many families, demand has been financially destroyed. They still want the house, they just cannot get there. Now here is where it gets even more complicated. Child care is expensive for parents, but child care providers are also under pressure. The original video made a very important point. Many child care providers face higher rent, higher insurance, higher operating costs, and fewer affordable locations. When those costs go up, they get passed on to parents. So this is not simply daycare owners are charging too much. It is bigger than that. If rent for a daycare center rises, the business has to charge more. If insurance rises, the business has to charge more. If labor costs rise, the business has to charge more. If smaller home-based providers shut down, parents have fewer options. And when supply goes down while demand stays high, prices rise. That is basic economics, but the emotional impact is brutal. Parents are stuck. They need childcare so they can work, but they need work so they can pay for childcare. And after paying for childcare, they may not have enough money left to save for a home. That is the loop. Work to pay for childcare, pay for childcare to keep working but never get ahead. Never get ahead, so never buy the house. That is why childcare belongs in every serious housing market discussion. Because if a family is spending a mortgage-sized payment on daycare, they are not going to be strong homebuyers. They might technically have income, but their usable income is gone. Now add inflation. This is where the pressure becomes overwhelming. Housing does not exist in a vacuum. When gas goes up, commuting gets more expensive. When energy goes up, utility bills rise. When transportation costs rise. Groceries rise. When groceries rise, savings disappear. When insurance goes up, monthly budgets break. So the buyer who was trying to save 30,000, 50,000, or 80,000 for a down payment is now watching that money get eaten month by month. And this is why people are not just frustrated, they are tired, because they feel like every time they get closer to the goal moves further away. They save money, then rent rises. They get a raise, then groceries rise. They cut spending, then insurance rises. They pay off one bill, then child care rises. They wait for mortgage rates to fall. Then home prices stay high. It creates a feeling that the system is designed to keep them running in place. And that feeling matters because housing is not only about numbers, it is about confidence. A buyer has to believe. I can afford this. I can keep my job. My income will grow. My expenses will not explode. The home will not lose value. I will not regret this 6 months from now. But right now, many buyers do not believe that. They look at the economy and they see uncertainty everywhere. They see layoffs. They see inflation. They see mortgage rates still high. They see insurance companies raising prices. They see property taxes rising. They see groceries still expensive. They see childcare eating family budgets, so they ask the most rational question in the world. Why would I rush into the biggest financial commitment of my life right now? That is not fear. That is survival instinct. Consumer confidence is one of the most important signals in housing, because buying a home is not like buying a phone. You do not just look at the price and decide. You have to believe in your future. You have to believe your job is safe. You have to believe your income will continue. You have to believe the economy will not collapse. You have to believe the home will be worth the risk. When people feel confident, they buy. When people feel uncertain, they wait. And right now, many Americans are waiting. They are not waiting because they love renting. They are not waiting because they do not want stability. They are not waiting because they do not understand the value of ownership. They are waiting because the math feels dangerous. And once that psychology enters the market, it is very hard to reverse quickly. A lower mortgage rate might help, but it will not instantly fix fear. It will not instantly refill savings accounts. It will not instantly lower child care costs. It will not instantly reduce insurance bills. It will not instantly make buyers feel secure. That is why the idea of a sudden housing comeback feels unrealistic. The buyer is not just rate sensitive. The buyer is financially exhausted. Now the industry keeps blaming the lock-in effect. They say homeowners with 3% mortgages do not want to sell and trade into a 6% mortgage. That is true, but it is not the whole story anymore. Inventory is rising. At the end of April 2026, there were 1.47 million unsold existing homes on the market, up year over year. So yes, some homeowners are still locked in. But more homes are coming to market. The bigger problem is that buyers are not absorbing the supply fast enough. And if inventory keeps rising while buyers stay cautious, sellers will eventually face reality. They can either cut prices or sit. That is why you are already seeing weakness in some markets, not everywhere. This is not a national crash happening equally in every city, but it is a split market. Some expensive areas still have buyers. Some luxury markets still have cash. Some wealthy households are still fine, but the normal buyer is struggling. The first-time buyer, the younger buyer, the family buyer, the buyer who needs financing. The buyer who does not have rich parents helping with the down payment. The buyer who cannot just write a cash offer. That buyer is disappearing, and when that buyer disappears, the market loses its foundation. Because a healthy housing market needs first-time buyers. Without them, the chain starts to break. If first-time buyers cannot buy starter homes, then starter home sellers cannot move up. If starter home sellers cannot move up, then move-up sellers lose demand. If move-up sellers lose demand, the entire market slows. That is how weakness spreads. Slowly at first, then suddenly. Now some people will say, but home prices are still setting records, so the market must be strong. Not necessarily. The median price can be misleading. if fewer affordable homes sell. And more expensive homes make up a larger share of transactions. The median price can stay high even while normal buyers are disappearing. That is why a record median price does not automatically mean a healthy market. It can also mean the market is becoming more unequal. The top of the market can keep moving while the middle and bottom are frozen. That is exactly what makes this housing market so confusing. You can have record prices and weak demand at the same time. You can have rising inventory and high prices at the same time. You can have wealthy buyers still buying while first-time buyers disappear. So when someone says, prices are still high, so everything is fine, they are missing the deeper problem. The market is not fine if only the strongest buyers can participate. That is not strength, that is exclusion. A healthy market should allow working families to buy normal homes with normal incomes. But that is not what we have right now. Right now, the market increasingly rewards people who already have assets. People with cash, people with equity, people with family help, people who bought years ago, people who locked in low rates. And it punishes people trying to enter for the first time. That is why so many young Americans feel like they are being locked out of the American dream, not because they refuse to work, but because the starting line moved too far away. Now let us look at the other side of the market, landlords and rentals. The original video talked about pandemic-era eviction moratoriums and how some landlords are now suing the government to recover losses. This is not just a random complaint. Reuters reported that the U.S. government chose not to ask the Supreme Court to hear a lawsuit over the pandemic eviction ban, leaving in place a ruling that may allow landlords to pursue compensation claims. The case centers on whether the CDC eviction moratorium amounted to a taking of property under the Fifth Amendment. And the claims could involve massive financial liability. Now, whether you side more with renters or landlords, you need to understand the economic effect. When landlords lose money, they do not simply forget it. They respond, they screen tenants harder, they require higher credit scores, they ask for more income verification. They increase deposits where allowed, they become less flexible, they raise rents to price in risk. Some sell their properties completely, and when landlords sell, those rental units may leave the rental market or get consolidated by larger investors. Either way, the cost does not disappear, it gets pushed back into the system, and the person who pays is usually the renter. This is why housing policy can have long-term consequences. A rule might be created during an emergency. It might help some people short-term, but years later the market can still be reacting. And now renters who struggled during the pandemic may face a harder time getting approved. Landlords remember what happened. Lenders remember what happened. Insurance companies remember what happened. Everyone prices in risk. And when risk gets priced into housing, housing becomes more expensive. That is the cycle, the government intervenes. The market reacts, costs rise, the average person pays. Some people think, well, if buying is too expensive, just rent. But renting is not exactly cheap either. In many cities, rent has already consumed a huge share of household income. And if you are renting while trying to save for a down payment, you are fighting two battles at once. You have to pay today's rent while saving for tomorrow's house. But if rent keeps rising, the down payment gets delayed. If child care rises, the down payment gets delayed. If car insurance rises, the down payment gets delayed. If groceries rise, the down payment gets delayed. And the longer you wait, the more home prices can move away from you. This is why so many people feel stuck. Renting does not feel like freedom, buying does not feel possible, so people end up trapped in the middle. They are paying high rent, but they are not building equity. They want to buy, but they cannot save enough. They wait for prices to fall, but prices do not fall enough. They wait for rates to fall, but rates stay high. They wait for income to rise, but inflation eats the raise. This is not just a housing problem, this is a wealth-building problem. Because for decades, home ownership was one of the main ways middle-class Americans built wealth. But if the next generation cannot get into ownership, then wealth inequality gets worse. People who already own assets keep benefiting. People who do not own assets keep falling behind. And that is exactly what many Americans are feeling right now. They are not just losing a house, they are losing the path to stability. So why do so many experts keep getting the housing market wrong? Because many of them look at the market from the top down. They look at rates, they look at inventory, they look at supply, they look at prices, they look at transaction forecasts. But they do not always look at the household, and the household is where the truth is. The household does not care about a national forecast if the monthly payment does not work. The household does not care about a housing reset if daycare is eating $1,500 a month. The household does not care about inventory improving if insurance just jumped 30%. The household does not care about seller optimism if groceries, gas, and rent are already too high. That is the disconnect. The industry keeps asking, how do we get buyers back into the market? But the real question is, how do buyers survive the cost of living long enough to become buyers? That is the question nobody wants to answer. Because the answer is ugly, it means home prices may need to adjust. It means sellers may need to cut. It means builders may need to offer incentives. It means agents may have to accept fewer transactions. It means lenders may not get the volume they expected. It means the entire housing machine may have to slow down until the buyer can breathe again. And nobody in the industry wants that. Because the housing industry makes money when people transact. Agents make money when homes sell. Lenders make money when loans close. Builders make money when homes are bought. Platforms make money when people search and click. Analysts get attention when they sell hope. So there is always pressure to say, the recovery is coming, but hope does not pay the mortgage. Math does. And the math is broken. So no, the housing market is not frozen because of one single thing. It is not just mortgage rates. It is not just home prices. It is not just inventory. It is not just inflation. It is all of it at the same time. A buyer today is being asked to do something almost impossible. Buy a record-priced house with a high mortgage rate. While paying inflated rent, expensive childcare, higher gas, higher insurance, higher groceries, medical bills, student loans, and dealing with weaker confidence in the economy, that is why the market is stuck. Not because Americans do not want homes, they do. But wanting a home and being financially able to buy one are two completely different things. And the housing industry does not want to admit that, because if they admit the buyer is broken, then the entire recovery narrative falls apart. The buyer is not just waiting, the buyer is damaged. The buyer is tired, the buyer is looking at the numbers and saying, this does not make sense, and honestly, they are right because a home should not require financial perfection. You should not need too high incomes. No kids, no debt, perfect credit, family help, and perfect timing just to buy a normal house. But that is where the market has gone. And when normal people need abnormal conditions to buy normal homes, the market is not healthy. It is distorted. So here is the uncomfortable truth. 2026 may still be called the Great Housing Reset, but not because buyers suddenly came rushing back. It may be a reset because sellers, builders, agents, lenders, and analysts are finally being forced to accept that affordability is not a talking point anymore. It is the market. If buyers cannot afford the payment, there is no recovery. If families cannot save because child care costs like a second mortgage, there is no recovery. If wages lose to inflation, there is no recovery. If renters cannot build savings, there is no recovery. If consumer confidence is weak, there is no recovery. And if inventory keeps rising while buyers stay cautious, prices in weaker markets will have to adjust. That is the reality. The housing market does not care about optimism forever. Eventually, it cares about math. And right now, the math says millions of Americans are not just priced out of houses. They are priced out before the house even enters the conversation. So the real question is not, when will buyers come back? The real question is, how much pain has to hit the market before homes become affordable again? Let me know in the comments. Are you waiting to buy? Are you priced out? Are child care, rent, insurance, or groceries stopping you from saving? Or do you think sellers are still refusing to accept reality? Because this housing market is not just about houses anymore. It is about the cost of living crushing the American dream from every direction.